feature is accessible via the Q&A icon at the bottom of your desktop screen or in the three-dot menu at the bottom right of your mobile device. Please note, Q&A is the only source we take questions from. The Q&A icon is next to the chat icon. To share any comments or observations, but not questions, please use the chat feature. Ensure your chat response is set to all attendees so everyone can see your comments. Let's give it a try now. Use the chat, tell us who you are and where you are from in our great, big, beautiful country. Let's see some of those coming in. Chat, Toronto, welcome, Albert. Ajax, welcome from Rick, Winnipeg. Toronto, more Toronto, Kitchener-Waterloo, Pickering, St. Catharines, Oakville, Pickering, Kamloops, BC, Belleville, Mississauga, Vancouver. Wonderful, look at that, coast to coast. Many East Coasters out there. Paris, that's Ontario. Great. All right, so welcome everybody. Wonderful to have you here. Thank you for attending today. It is my sincere pleasure to introduce you to our guest, our very own Carolyn Verner. Carolyn is my colleague and she is the Director of Broker Services. And like me, she is also a longtime Royal LePager. Carolyn is in part, in her many roles, dedicated to the financial fitness of our brokerages across the country, helping our franchise owners to benchmark their revenues and expenses and find efficiencies in their business. As an accountant, Carolyn's unique professional experience and intimate knowledge of brokerage and agent finance make her well-positioned to help you forecast your cash flows and stay as financially healthy as possible during and after the pandemic. Plus, Carolyn will share information on the government assistance you may be eligible for. So thank you so much, Carolyn, for joining us today. And I'm going to throw it over to you now. Welcome.
Thank you, Kelly. Hi, everyone. I hope you and your families are all keeping well. Now, these are certainly unprecedented times that we're in, and with it brings a period of great uncertainty. Now, you've heard from a lot of other speakers, a lot of speakers before me with Kelly on how to stay physically and emotionally healthy, as well as getting your business prepared for the future. Now, I'm really happy to be speaking with you today about staying financially healthy in these uncertain times. Now, I know that everybody knows the expression, time is money. But my favorite twist on that is money buys time. So when you started your real estate career, your broker probably told you to have cash reserves equal to about 6 months of expenses. This was to help you to maintain your standard of living while building your business. Now, you knew that it was probably going to take about 6 months to write that first deal and get that first commission check. About 6 months to really start earning money as a realtor. You know, it's funny because personal financial planners also very often tell their clients to have ready access to about 6 months of living expenses, just in case some unforeseen life event leaves them without, income for a period of time. Having healthy cash reserves in challenging times really does buy you time to think about the changes you want to make. And it offers you a greater range of options. Now, we're in one of those periods of change right now. So if you're coming into this with really healthy cash reserves, you're ahead of the game. But how long will your cash actually last? Today, we're going to talk about managing your financings through these uncertain times to make sure that you're really well positioned to thrive beyond the lockdowns when we're all back to business. Okay, so we're at a point in the pandemic right now where businesses are starting to reopen and we're gradually getting back to normal. But I think we all agree that it's going to be a new normal. So before we talk about managing your finances until business is humming again, you need to think about what type of business are you intending to get back to? What is your new normal? During the shutdown, we found lots of new ways of engaging our clients, new ways of preparing houses for sale, new ways of marketing and showing your homes. How much of those new ways are going to be a permanent part of your new normal? And are you ready for it? Now, you might have been active the whole time and you've already made all your changes and you're fully functional in your new normal. Or you might have had health concerns not ramping up to do. Or maybe you're just not quite comfortable yet with all the new technology. Now, there's no doubt that there's been a lot of change in a very short space of time, and that can be overwhelming. So the first step in figuring out your finances is deciding what your business will look like when this is all over, and take an honest look and think about what you need to change to get ready for it. Now, you're lucky that there's some time right now. You've got a little time and you've got a lot of no cost and low cost resources at your disposal to help you get ready. Now, there are two reasons why I'm talking about getting ready for your new reality. The first one is that the more prepared that you are to do business in your new way, the sooner you'll be writing and closing deals again. And so the shorter the time that your reserves need to last you. Now, the second reason is that you really need to know what getting prepared is going to cost you. And so you can better understand how much cash you actually need right now to be able to finance that. So, organizing your database now is good financial management. Attending all those RLP Sphere webinars that are out there so that you can adopt the latest technology when it launches, that's good financial management. And updating your marketing materials and sharpening your sales skills, those are good financial management. Because these are all great ways to shorten the time to your next commission check. And by the way, don't neglect your emotional health, because we're in a relationship business and it requires you to have an infectious positive attitude when you're working with your clients. And that's pretty impossible to do if you're not emotionally healthy yourself. So don't neglect yourself. Join in all those social experiences that are all around, these Zoom calls. In fact, go out and dance on the balcony. Everything you do that gets you closer to that next commission check is good financial management. Okay, so let's really talk about money now. I'm well aware that it's the rare realtor who has ever created a budget, much less a cash forecast. You sort of know how much you need to live on. And if you're getting short on cash, you think, I'll just go out and sell another house. But that's not so easy to do during a pandemic lockdown. So now you need your cash to last. So it's actually important to know how much you really need. And it might surprise you to figure out how much you spend and on what. Every time I think about how much someone spends, I think about my daughter. Now, my daughter's wedding was planned for the first week of June this year. And yes, of course, it's postponed. It's one of those victims of COVID-19. But anyway, in 2018, she started planning for this wedding. And I heard her explaining all the events. And when I heard all the fancy things she wanted to do, the accountant in me just heard ka-ching, ka-ching. You see, my husband's Indian, which means a wedding is a whole week affair. So I asked her if she had figured out how much it was going to cost. And she proudly told me that, what her budget was and that how well she was doing keeping down the cost of everything. And in fact, she had made a spreadsheet for each of the events just to figure out how much it was going to cost. So of course, when I heard all of this, I said, that's great. Let's sit down and create a budget with everything included. Needless to say, by the time we were finished, that wedding was going to cost twice her original estimate. Now, just the fact that we were writing everything down in the same place, she started to remember all those things that didn't make it onto one of her individual spreadsheets. Okay, so once we understood the cost, then we started thinking about where all this money was going to come from to pay for it all. And that included, you know, gifts from guests, mom and dad, of course, and contribution from the couple themselves. It's no different for you, for your business and your life. The process is exactly the same. Figure out what you expect to spend and then where the cash will come from. And then you can look back at and question the spend if necessary. But when you're figuring it out, make sure you're writing it all down in one place, because otherwise it's too easy to forget all those little things that really do add up. And when you're thinking about where the cash comes from to pay for it all, remember there's always more than one source of cash. So here's where you sit down and really think about what it costs you to live right now, as well as over the next few months, until your income is really flowing freely again. Write down all the things that you spend money on, how much each costs, and when you need to pay for it. Think of everything it takes you to run your business or really you want to think about everything it's going to take you to run your business in the new way going forward. Write all of those things down. When you look at the list, it'll jog your memory for all those little things that you missed as well. It's also a good idea to go through your bank account and your credit card statement and see what you spent and what you spent it on. But when you're doing that, remember that some of the things you used to spend on, you won't anymore. And there are some new expenses that are going to come into play. Because both your life and your business has probably changed, right? There's less restaurant and travel, more groceries, maybe booze. You might need to invest in some new technology for your business. Or actually, you might be able to replace some of the technology that you're paying for now with some of the new technology that's going to be provided to you by Royal LePage or your own brokerage. And maybe that will allow you to even have some savings going forward. Now, if you're buying new software, think about whether it's a one-time upfront cost or if it's monthly fees. It's important to know when you're going to need the cash to pay for it. And if you're deferring costs, write down when they're actually payable now. For example, you may have deferred mortgage payments or rent, and if you've deferred rent, that might be due the next 2-3 months. You might have no rent to pay now, but a much higher rent in a couple months. And if you deferred mortgage, maybe amortized over the or it might have been tacked on. So make sure that you really know for your deferred payments when they're going to come due, so that you put the right amount in the right column in the cash forecast you're going to do. So I've given you a list here that gets you started, but obviously you're going to have to fill that in and flesh it out. So now that you know what you want to spend, think about where the funds are going to come from. What income do you have coming in right now? And how do you expect that to play out over the next few months? Think about it. Not just your commission income, though. All the income that you have from every source. Now, maybe you have rental properties and you have to know, did you defer the rent for your tenants? Because if you did, maybe you have lower cash flow coming in now, but you have some more coming in 2 or 3 months. Write down exactly the cash you expect in each month separately. So that's income. But what about your personal savings? Do you have money in a savings account, maybe in a TFSA? You know, you can take that out without penalty. Just don't put it back in the same year. So have a look at how much you have saved. What government programs might you qualify for? And if all of those sources of cash just don't cover what you need, then what credit is available to you? Could be available to you as an individual or available to your business if you're organized in that way. Okay, so here's how I suggest that you organize everything we just talked about. Everyone on this call has Google Sheets. And if you haven't already, this is a perfect time for you to use it. Can you tell I'm an accountant? What you're going to do here is you're going to create a very simple cash forecast. We're going to start with the inflows and outflows in each month here. So write the months across the top. So we're creating a spreadsheet here, hence Google Sheets. Write the months across the top because every month is going to be different, right? You're going to have different cash coming in and different expenses, cash going out each month. The top section of the forecast deals with the cash that you are expecting to get. And the bottom section deals with the cash you're expecting to spend. If you expect to get more cash than you spend in a month, then in that month you have positive net cash or net cash inflow. And if you're expecting to spend more than you get in that month, then you have net negative cash or negative net cash or net cash outflow. Now, this is very different from doing a budget where you itemize your income and expenses. And that's because cash comes from things that are not your income and it goes to things that are not your expenses. So let's take loans, for example. Money you borrow is not your income, but it is a cash inflow, right? And when you repay that loan, that repayment is not an expense, but it is an outflow of cash. So cash forecasts are different from budgets. So you get the concept. Now let's put some actual numbers to it. Let's say that you don't have a deal closing in May or June, but you're getting government assistance of $2,000 per month while you're off. You still have to pay your board fees and your cell phone and maybe a few other fixed expenses. Let's say that's $500 in May. Now your personal expenses are $2,500 for the month right now. So we have that under personal expenses. And you're still paying your car loan because you weren't able to defer it. So that's $1,000 in May. But you did defer your April and May mortgage payments, but you have to start paying payments again in June. So you see loan payments went up from $1,000 in May to $3,000 in June. That's because you started paying your mortgage as well. Now, based on the way that you're ramping up right now, you expect to be able to earn $10,000 on commission in July and $30,000 in August. Now, of course, we know that that brings with it higher business expenses, which we all know we spend long before that deal closes and the commission is paid. So you'll see business expenses are going up in June and July for that July and August commission. Now, also income taxes. Income taxes, the government is allowing us to defer till August, and we'll talk about that later. But I've got 15,000 of income taxes in this spreadsheet as an assumption that you're going to have to pay 15,000 in income taxes in August. The number is just an example. Now, in this case, every month, look at the bottom line, every month we have negative cash outflow because we have cash, more cash going out than the cash we're expecting to come in. So now let's talk about how we're going to make up those shortfalls. Now, remember the first thing we talked about was having cash reserves? Here's where you look at yours. Are you sitting on a lot of cash right now? Or is the well dry? What's the balance in your savings account and your TFSA? What's in your business account if you're organized that way? Now we're going to turn to the cash. We're going to turn the cash flow you just did, this, into a forecast. So we already know that what each month's estimated net cash inflow or outflow is. And unfortunately, in our example here, we only have outflows, net outflows. Now you're going to put the starting cash balance and see how that changes over time. So let's say that you saved $15,000 to pay your taxes, but you don't have any more savings. That was it. You weren't really expecting this. You didn't have cash reserves. You just had the money that you knew you were going to have to pay for your taxes. So make that your starting cash, because that's what you have in the bank right now. Then put the net cash outflow from May, the one you expect to have to pay the rest of this month, put that in the line below your starting cash, and then add the two together to get the amount that you're expecting to end the month of May with. Now remember that the amount that you end the month of May with is the same amount that you start the month of June with. So that 13,000 at the end of May is the same 13,000 beginning of June. Okay. Now you want to do this for every month until that month where you're expecting business to be back to full steam and your commission is flowing really well again. In this example, I've just forecasted it out to August. Now the last row of the forecast is the cash you expect to have at the end of each month. And see that negative 500 under August? That means that you've run out of cash in August. You've exhausted your cash reserves by then. And you know, that's if you actually do earn 30,000 in commission in August and 10,000 in July. Remember those assumptions we made earlier? So it's a good bet that you'll need to make up a shortfall in August and maybe even in July if the ramp up doesn't happen the way that you had expected. Now let's see what it would have looked like if you had had a little more money saved. Now let's say that in addition to the 15,000 for taxes, you had also saved another 15,000. So you came into this with $30,000 in the bank. You're not really as dependent on hitting that 30,000 in August anymore. You might actually be okay if the ramp up isn't exactly the way you expected it. As I said at the beginning, money buys time. Now, I know that doesn't help you right now, but think about the next time you have a seasonal dip or, this is a very seasonal industry. We see dips in the winter time. Good to have cash reserves built up. And even if you're not expecting a dip, nobody expected the pandemic, good to have cash reserves built up. Okay, so if you do need to make up a shortfall, let's say you didn't really have that much coming into this, you have a few choices. So you could cut costs or defer more expenses or, borrow. So this is where you revisit that list that we talked about creating. Now, question everything, both personal and business spending. You might have different ways of achieving the same business goal. So go for the lower cost option if you're short on cash. Obviously, the more cash you have, the more options you have. Now, if you are thinking of reducing your expenses to close the gap, remember not to cut the things that will truly help you to ramp up faster. This could ultimately hurt you more than it helps you. Remember, the faster you can get to that next commission check, the shorter the time these reserves have to last you. So it's really important to prioritize those things that will get you there faster. Now, you might try to defer some more expenses. So think about, are there any other expenses that you could defer without interest or penalties? And if you have to pay interest, how much is that going to cost? And if you do decide to make up the cash requirements by borrowing, then remember to use your least expensive borrowing method. Now, what options do you have? Credit cards can sometimes be pretty expensive. So use your lowest rate credit card first. You might even be able to get your credit card company to reduce the rates for you right now. Or maybe you have a line of credit. What's the interest rate on your line of credit? This might also be a good time to see if the bank of mom and dad is still open. Mine isn't, but yours might be. Okay, now let's look at the ways that the government is helping. There are government programs that are available to individuals, and there's some that are just available to businesses. And I'm going to go through them one at a time with you. So let's start with something that everybody has. Now, the government has given us extra time to pay our taxes. If you're a self-employed realtor or any other self-employed person, then you must file your taxes by July 15th, but you can defer payment until September 1st. And honestly, I suggest that you think of that as August 31st. Okay, so that you put that cash requirement in the August column, not September, because September 1st, you don't have any time in September to get that cash. Think of it as August 31st, please. Now, your staff, if you have any, or any of us who are not self-employed, we have to file our personal taxes by June 1st, which of course we've got a couple weeks to go now. But we can also defer our payments to September 1. And again, I'm going to say August 31st. And if you're incorporated, and let's say that your actual usual filing date is between March 18th and June 1st. So only if it's between those dates that you normally have a deadline for filing your corporate taxes. The government is allowing you to file by June 1st and pay by August 31st. I'm going to say August 31st. I don't like that September 1st thing. Okay, so now GST and HST. If you have GST and HST remittances that you were supposed to have paid anywhere between March 27th and May 31st, you get to defer those GST payments to June 30th. So we're in May now, you really need that cash next month, okay? June 30th is your deadline for the GST and HST remittances. Okay, many of you may have already taken advantage of the CERB, the Canada Emergency Response Benefit. And if you haven't, and you find out that you qualify for this, don't worry, you have until December 2nd to apply for retroactive payments. So first, let's talk about who's eligible. The rules say that it's for those who have stopped working due to COVID-19, but not anyone who has voluntarily quit their job. Now, there are different valid reasons why COVID-19 would cause you to stop working. You could be laid off. You could be sick or quarantined. or you could be taking care of someone who's laid off, sick or quarantined, well, not laid off, but sick or quarantined, or actually you could be taking care of a child because daycares are closed. Now, all of those reasons qualify. Another criterion is that you have to have earned $5,000 in income in either 2019 or the 12 months before you stopped working. Now, that shouldn't be a barrier to anybody on this call. Now, you can qualify if you're an employee or a contractor or self-employed like a realtor. Now, here's the big issue. To qualify, you also have to have earned less than $1,000 in the first 2 weeks of the first 4-week period that you apply for, and less than $1,000 in the entire 4-week period for every subsequent application. So I'm going to say that again. So it's less than $1,000 in the first 2 weeks of the first 4-week period that you apply for. And then for every 4-week period after that, you can't earn more than $1,000 in the whole 4-week period. Okay, so it's a little different in your first application and then every one after that. Now, this benefit is available for 16 weeks, roughly 4 months, between March 15 and October 30th. And you must apply for each of those 4-week periods separately. Now, so you'll receive $2,000 for each 4-week period in which you apply, in which you qualify. Now, I've got to remind you that this benefit is taxable. So you need to expect to declare it and pay taxes on it next year when you file your 2020 tax return. And the government isn't taking any taxes when they send you the check. They send you the whole $2,000. Okay, so those are the programs for individuals. Let's talk about the programs that are for businesses. Now, some of you are running teams and you've got employees on payroll, and you've set yourself up as a business. So the first business program I'd like to talk about is the CEBA, Canada Emergency Bank Account. Is to cover operating costs. And the business must have been in operation before March 1st, 2020, and intend to stay in operation after the pandemic. The company has to have total 2019 payroll of between $20,000 and $1.5 million. The company must have a business checking bank account and not be in arrears over 90 days on any existing credit facility with the bank. Now, in addition to these criteria, there are restrictions on the use of the borrowed funds. So it's to be used to pay non-deferred operating expenses. And it's not to be used to pay dividends or distributions to the owner or to increase management compensation. Now, I know some of you have questioned the requirement for the business bank account because you've been using your personal bank account for your business. You meet the qualification for payroll, between 20,000 and 1.5 million. And you have been and intend to stay in business, but you can't access the funds because you don't have a business bank account. So let me try to explain why this is a criteria. First of all, this is a business loan administered by commercial banks and credit unions. They do a fair amount of due diligence when they're opening a business bank account for a company. And the government appears to be relying on that to ensure that funds are indeed being loaned to businesses. Now, in addition to that, there are limitations on how the funds can be used. And in fact, those limitations prohibit the funds to be used by the owner of the business, either to be distributed to the owner or to increase management compensation. So if you think about it, putting the funds in the personal bank account of the owner of the business immediately violates that restriction on the use of the loan. So think about it, guys. A bank can't lend money to a business that doesn't have its own bank account. I hope that clarifies the rule for you. I know that's not what some of you wanted to hear, but sorry. Okay, so now if you do qualify for this program, it provides interest-free credit facilities of up to $40,000, and different banks have different ways of giving you that $40,000 or the amount that you qualify for. Now, regardless of how you get it though, if you repay the loan by December 31st, 2022, then 25% of it will be forgiven. So obviously that's up to $10,000 if you get the full 40. Now, if the loan is not repaid by December 31st, 2022, then the balance is converted into a 3-year loan at 5% interest. If you qualify for this, then just apply through the commercial bank where you have your business checking account. Now, apart from increased access to credit for businesses, there are 2 wage subsidy programs that the government has to help employees. Well, there are 2 wage subsidy programs to help companies who have employees on their payroll. There's the the Canada Emergency Wage Subsidy, or CEWS, and there's the temporary 10% wage subsidy. So let's look at the CEWS first. You know, that's the 75% wage subsidy that most people have heard of. And to be eligible for this subsidy, you must show a revenue decline of 15% in March and 30% in April and May. Now, revenue includes only amounts from arm's length sources and no extraordinary items like sale of assets, for example. And you must calculate your revenue in your normal account with your normal accounting method, unless you elect to use cash. Now, for realtors, there's not a whole lot of difference between your normal accounting method and cash, because usually you record it when your commissions are earned, right? When they flow. Now, there are currently 3 eligible 4-week periods between March 15 and June 6th. But the Prime Minister announced last week that the program is going to be extended beyond June. He just hasn't given us any details yet as to how that's going to happen. So we're staying tuned for details. For each period, you get to compare your revenue in 2020 to either the same month in 2019 or the average of January and February 2020. Now, the first time that you apply, you have to decide which of those 2 methods you're going to use, and you have to stick with that one for every subsequent application. Now, there's one more thing. If you qualify for one period, the government will immediately qualify you for the next month. So if you have a 30% revenue reduction in April, so you qualify for April, you'll immediately qualify for May. You don't have 30% to qualify. Okay, so the government has done that to help employers keep staff employed with some degree of certainty. So at least you get 2-month chunks. Now, you'll notice on this chart here that the payroll period that you apply the subsidy to doesn't exactly line up with the month whose revenue you're trying to prove the reduction in. So for example, to calculate a drop in, you calculate a drop in revenue in March. So either March 2020 versus March 2019, or March 2020 versus average of Jan-Feb 2020, sorry. You prove March in order to get a subsidy for the payroll period March 15th to April 11th. So it's not quite the same period. And each one is just as you see on the chart here. It's a little misaligned. Okay, so now let's look at an example. Now, first you need to figure out the reduction in the revenue to see if you qualify. So I assume that you have accounting software for your business, right? And you want to run an income statement for 2019 and 2020. Now, I suggest you run a monthly income statement. Most accounting packages can give you a monthly format. I know QuickBooks and Lone Wolf can do it. Some others might be able to do it as well, where you see each month's income statement in a column all in one report. If you can't do that, then you'll have to run each month separately. But so run your income statements. And what I suggest you do is do a little spreadsheet, just as you see that I've done here, and put all the months at the top, and then put your 2019 revenue from the top of your income statement and your 2020 revenue just below each month. Now you're going to need January and February 2020, because remember, the average of January and February is one of the ways that you can use, one of the things you can use as a base period when you're comparing. But you really don't need January and February 2019 for anything. So for each month in 2020, calculate the percentage in 2020 over the same month of 2019. So what's the change? What's the percentage change for March 2020 over March 2019, April 2020 over April 2019, that year-over-year change? In this example, the revenue was up 50% in March and up 33% in April. Well, we know that most realtors were still closing deals that were written pre-pandemic in March and April, so that's not an uncommon scenario. And in fact, I know that in some markets, a lot of people were rushing to get deals finished just at the beginning of the pandemic lockdown. Now, this scenario shows revenue reduction in May 2020 as compared to May 2019 was down 67%. And then June was down 27% from the previous June. Now, the other way, as I had said, to do the comparison is to use the average of January and February as a base. So calculate what the average revenue of January and February 2020 is. And in this scenario, I've got $20,000, average of $30,000 in January and $10,000 in February. So that 20,000, that average of January and February, that's going to become the base for all the comparisons, March, April, May, and June. This is just one option that you have. Now, in this example, the revenue in March is 125% higher than the average of Jan-Feb. And it's 100% higher or double in April. It's 25% lower in May and double again in June. Now, January and February are traditionally bad months in real estate, with low revenue. So it's not unusual. It wouldn't be unusual to see something like this. But there are some cases where that Jan-Feb average might give you a high enough revenue to prove the decline. Because there are some people who close really huge, let's say, commercial deals in January or February. I have seen realtors have very high income in January. And if you're one of those, do the calculation both ways, decide which way works for you. Just remember that the minute you choose a way, you have to stick with that way. So obviously in this scenario, the company qualifies in May because the reduction in revenue is more than 30%. Now, I know June hasn't happened yet, and I have numbers in here, but this is just an example. And we don't really know what the rules are going to be in June, but I'm assuming here that the Prime Minister is probably going to just keep the same rules in place. There's no guarantee, so wait for his announcement. But let's say that he does extend to June in the same way that he has it right now in March, April, May. Even though there's only a drop of 27% in June, this company would still qualify for June. And that's only because when they qualified for May, they automatically qualified for the next month, which is June. So if you show that 30% reduction in May, you get 2 months. Okay, now you'd have to go and qualify again in July if he extends it that far, and if you, if the rules are the same. Okay, so now that we know how to qualify for the CEWS, what exactly is it we were trying to qualify for? So the subsidy, here's what you get. And it's a little bit complicated, so I'm going to walk through this with you. You get the greater of two things. You get the greater of 75% of each employee's wage to a maximum of $847. So you have to know you're doing each employee separately here. You're not combining them all. Okay, so 75% of each employee's wage to a maximum of $847, or the lesser of two things, the amount that you pay them right now, so the total amount you pay them right now to a maximum of $847, and 75% of what their pre-crisis weekly pay was. So if you think about it, if you're only paying them 75% of what they used to earn before the pandemic started, and that's less than $847 a week, you're actually eligible for a full subsidy of what you're paying them right now. That's because what you're paying them right now is 75%. If you're paying no more than 75% of the pre-crisis wage, and that is less than $847 a week, you could get all of it as a subsidy. Now, if you're thinking of rehiring your assistant that you laid off, remember that he or she cannot benefit from the CEWS and the CERB. It's one or the other. So if you're going to be paying them between $1,000 and $2,000 a month, they're actually better off staying on CERB themselves. Okay, that's because if it's below $1,000 a month, they still qualify and they can still get the CERB. And if it's more than $2,000 a month, then obviously you're paying them more than they get from the government. And so that's also beneficial. But if it's in between the $1,000 and $2,000 a month, they're actually better off staying on CERB. So think about, before you rehire people, think about what's most beneficial for both you and them. Okay, now each 4-week period has its own application, and actually applications open today for the second 4-week period. The first one has been open for 4 weeks right now, and the second one opens just today. Now you really do have to keep stellar records here. So keep records showing how you calculated your arm's length revenue reduction and how much you paid your employees. There are penalties for accessing funds for which you're not, to which you're not entitled. So please make sure that you have all your backup documentation just in case you get audited. Okay, now if you don't qualify for the CEWS, you can still get the temporary 10% wage subsidy. And for this subsidy, you calculate the amount that you are entitled to. So you calculate what you're going to take manually, and you reduce the your regular payroll remittance. So this is not something the government gives you. This is something you actually have to calculate and take yourself. It's equal to 10% of your total payroll from March 18th to June 19th to a maximum of $1,375 per employee and $25,000 per employer. Now, in this case, it doesn't matter how much each employee earns. The $1,375 is compared to the average of your total subsidy divided by the number of employees you're paying. So let's say that you have a team with 4 employees on payroll, and you can't qualify for CEWS because the revenue, you just didn't have the revenue decline that you need. You weren't down 15% in March or 30% in April or May. Well, we don't know May yet, but maybe May is still shaping up to be really good for you and you don't expect to be down 30%. So let's suppose that the total that you pay all of those 4 employees is $10,000 a month. Your subsidy is 10% of that, which would be $1,000. And over the course of the 3 months, it means that you would have taken, if you have all 4 of them all the time, you'd have taken $3,000 in subsidy. And remember, you subtract that subsidy from the tax, the payroll remittance that you're paying. So you've taken $3,000 and it's for 4 employees. So at the end of the day, you divide the 3,000 by the 4 employees. On average, your subsidy is $750, which is well within the $1,375. And your total subsidy you took was $3,000, which is well within the $25,000. So you're fine. Now, one of the other things it does is that number of employees that you're dividing to get that average, you can use the highest number of employees you had throughout the period. So let's say that in period 1, you had 4 employees and you paid $10,000. And in period 2, you only had 2 employees and you actually kept your very high paid employees and they were $8,000 for the 2 of them combined. And same in period 3, $8,000 for 2. Now, you get 10% for each of those periods. So 1,000 for the first, 800, and then 800. So in total, you've taken 2,600 in subsidy. Even though you only paid 2 people in period 2 and period 3, you get to take the highest number you paid in any period. So you get to check your maximum against 4 employees. And so you take the $2,600 that you've taken in total, you know that's less than 25,000, so you're clear there. Divide it by 4, your average subsidy is $650. And that's well below the $1,375, so you're fine. Okay. Now, any amount that you take from this subsidy, and actually either of the subsidies, any amount you take, you have to record as income because the wage subsidies are taxable. Okay, so everything you take here, you record as income, and that goes on your business income tax, of course, because these are business subsidies. If you take this thinking that you haven't qualified for CEWS, and then you find that you actually do qualify, you can still apply for CEWS, but anything you take here, the amount you get from CEWS is supposed to be reduced by the amount you've already taken. So there shouldn't be any double dipping between these 2 programs. It's one or the other. Well, it's both, but it's never supposed to be more than you get for CEWS. So you have to subtract what you've taken here. Okay. No double dipping, guys. Okay, so let's wrap up. Let's summarize what we've talked about today. First, I really suggest that you create a spreadsheet. Try out Google Sheets. Create a spreadsheet that details what you're expecting to get in terms of cash and what you're expecting to spend so that you can see what your net inflows or outflows of cash are. Remember, it's not the same thing as your income statement. It's inflows of cash, outflows of cash, okay? Not income and expenses. Think about how you want to operate going forward. Think about what that's going to cost you going forward, and actually what it's going to cost your business. What sources of cash do you have? What government programs might you qualify for? You know, both personally and your business. Remember, go through your list, write everything down, find the gaps, try to create that cash forecast, including the government programs, just to see how long the cash reserves you have now. Even if you have lots of cash reserves, how long will they last? What kind of ramp up are you expecting? And for you guys who've been around a while, what did 2018 look like for you? How long did it take you to get back up and running? I know it's not the same thing. Pandemic is totally different. These are completely unprecedented times, but it might give you an idea of how long it took you to get another deal in a difficult time, and not when deals are, you know, coming to you very easily. Okay, so I'm going to thank you for staying with me all the way to the end, and let's see now if there are any questions. Kelly?
Hi there. Thanks so much, Carolyn. Just a little bit of a proviso. This was a great webinar with lots of information, but our legal team wants you to know that the webinar and the information provided is for general information purposes, and it is not legal, business, or other professional advice. Every agent should consult their own legal and business advisors to determine how this information works within the context of your business and your various legal agreements. Now, Carolyn, before I get to the first question, we did have a point from Rick Peckman, so I just want to elaborate on that. You know, you talked about, for example, talking to your credit card companies to see if you could make any arrangements with your interest in your account. He said to reach out to car insurance companies, your cell phone provider, to see if other discounts are available during the pandemic. And I've heard that as well.
Very good advice. Absolutely. There are a lot of companies that are willing to defer or reduce the amount that they're charging you right now. And car insurance is actually a really good one, because if you're parked in your driveway, you're not doing the kind of driving that any realtor does in any month. In fact, it's not just the gas you're saving on. You can get a reduction in your car insurance because you're not the risk that you are when you're on the road 24/7.
Great note to self. And all, of course. Lots of questions on the federal programs and questions related to, you know, when is the income considered earned? Is it when the transaction goes firm, or is it when they're actually paid out in commission? So how is that considered and calculated? If you've already said it, just a good review, because there were quite a few questions on that.
So the real thing here is that the government wants you to use your normal method. The only exception to that is that you can go to cash. You can either use your normal method, or you can count it when the cash comes in. I would think that your normal method is probably when the deal closed, but only you and your accountant knows what your normal method is, which is why I suggest that you run your income statement and look at when it is that you are actually recording it. Now, if you're not running a business and you're just doing it personally, your normal method is cash, because that's how you pay your income taxes. So when do you get your commission checks? Look at the date on the commission checks. Does that help?
Great, thank you. If you don't have any sales during a particular period, but you've had previous closings, then you still qualify, right? Because it's about your income in lieu of the previous year. Would that be a correct assumption?
Okay, I'm not sure exactly what that means. If you're saying that your commission check is coming in this month, but you don't want to count it as revenue because you negotiated that deal some time ago, it's closing now. it depends on when you record your revenue. I would think you're recording your revenue right now. And so you need to look at that as this current month's revenue, not when you negotiated the deal. Unless your normal method is to record it that way. And very, very few agents. I don't know of any agent who records it that way, to be honest, but maybe you do.
Okay. Michael Mills wonders whether you think the CERB benefit is going to be extended.
I think the CERB goes to October, right? So we've still got a long way to go. So far, they are extending the CEWS, that we know for sure. And I know that the minister, who was it, of labor, or one of the ministers had said it's going to be months. It's not going to be weeks. So we're probably, right now, the prime minister just said it's beyond June. He hasn't really said how long. He promised to give us some details this week. But in terms of the CERB, I don't know. Not yet. It's still early days.
When we look at your what you talked to us about cash flows, we had a question from Mickey Candola. He's wondering if the cash flows can be automatically done with apps like Mint from Intuit, where you link to all your accounts, or should this only be done in a spreadsheet? And I know that recently Royal LePage has developed a partnership with QuickBooks. And in what way do you think QuickBooks could support us?
Okay, so this is a really good question, and this goes to the heart of me saying this is not an income statement. The difference between cash and now I don't know if Mint or any of these have a cash flow statement, but when you're talking about cash, you're talking more about your balance sheet than you're talking about your income statement. Your income statement only has revenues and expenses. It doesn't have all the different ways you get cash and all the different ways you use cash. That goes to your balance sheet. Your balance sheet says, here's everything that you own, here's everything that you owe, and if you took everything that you owe, the difference is what your business is worth. That's very high level.
Carolyn, oh, okay, there you are.
Oh,
every
sorry.
once in a while you freeze a little bit. It's been a bit patchy, but that's okay. I think it'll pick up in the recording. So maybe you could just repeat a little bit of that, what you just said toward the end, like the last 30 seconds.
Oh, I'm sorry. Okay,
No
just be careful if this is something that's driving off your income statement, because your income statement is not about cash. It's about revenues and expenses. Remember, I gave the example of loans. If you get money from a loan, it's not income. So it's not going to be anywhere on your income statement, but it is cash in. And when you pay that loan, it's nowhere on your income statement. It's cash out. So be very careful how you use these packages to try to forecast cash. I don't know that any of them have a really good cash forecasting model, but it could help you figure out how much you spend. Take the expenses and you go, oh yeah, I'm still going to do this. I'm still going to do that. I need all this money. And when you put it in your income statement, you're recording it when the invoice is created, if it's revenue, and when the invoice comes to you, which is your expense. In the cash, I want you to record it when you actually need to have the cash. So you might have an invoice, but you get an invoice in May and you don't have to pay it till August. In your income statement, it's in May. In your cash forecast, it should be in August. Does that give you an idea of sort of how it's different? Am I frozen?
No, you're not. I just can't answer that question. But
okay. Well, I hope that helps a little.
I'm sure it does. It's all Chinese to me, that's for sure.
Oh, no!
You make it a lot more simple, though, that's for sure. I'd probably have to watch this webinar a few times to kind of get the gist. So I'm not the best moderator for this session, folks, sorry. But we do have a lot of people who are asking questions who are new to the business, and that's got to be particularly challenging right now. Some folks who just got newly licensed, some folks who are maybe licensed toward the beginning of the year and they haven't had any earnings yet. Are they still eligible? And when they get those payments, are those payments taxable benefits?
So you should be eligible for CERB. I don't know what you were doing before. It depends, as long as you had earnings, and it has to be actual income, not benefits. So if you had $5,000 in income, regardless of what you were doing before real estate, either in 2019 or the last 12 months before you stopped working, before you stopped earning, you do qualify. You should qualify. Obviously, only CRA can tell whether or not you qualify. And you want to go on the website. You can apply through my personal account, my account on my CRA account, it's called. Or if you were an employee somewhere and if you quit your job, then you don't qualify. You only qualify if you had stopped working because of COVID-19. But you should be able to qualify, and it would give you $2,000 per month. As long as you didn't have more than $1,000 in the first 2 weeks of the first period, and no more than $1,000 in the whole 4 weeks of every period after that. Sorry, I'm not sure if that's answered your question, but.
We have another realtor who said that he applied for the CERB when it was first announced. He got the fund, but he had funds coming in that he hadn't expected. So he returned the benefit back to the CRA. When he applies in May/June, is he considered a first-time applicant if he's already given that first benefit he got back?
That's a hard one. I don't know. I don't know what CRA is going to say, but are you worried because you have more than $1,000 of income? If you have more than $1,000 of income, you're probably not going to qualify. But, only the CRA can tell.
So, we're over time right now, so I'm just cognizant of everybody's time, and I know that I'm late for my next meeting.
Oh, no.
But maybe as a good wrap up, it would be great to know where people can get help or support with these types of questions. Does the government have a hotline? Is there access to any support that they can reach out and ask those, challenging questions in terms of whether they qualify or not, and all the logistics involved and the implications?
So I tell you what's the government of Canada has an amazing website. And if you Google canada.ca/COVID-19, it starts there. You'll get a website, and there are so many links. Halfway down the page, it gives you benefits for individuals, benefits for businesses, and you click on the one that you're thinking of. It also has all kinds of programs listed there. You click and you keep clicking for whatever question you're trying to get to, and it will take you where you need to go. So start out by Googling canada.ca/COVID-19, and it's an amazing website. I would definitely start there. In fact, I do start there.
Great. Lots of thanks. Congrats. Good luck with your daughter's wedding.
Next year.
Everybody's rooting for you next year, and hopefully we're in a much different situation by then. But Carolyn, thank you so much for your expertise, your time, and your love for your fellow Royal LePagers. We appreciate it. Much thanks. And to everybody else, stay safe, and a recording of this session will be made available on rlpnetwork.com under the training section where webinars are housed. Please come visit and replay like I would need to do. All right. Thanks so much, everybody. Take care. Stay
Thanks
safe.
for inviting me, Kelly. Bye.
Cheers. Bye-bye.